Okay, now we're working continuously through this restructuring topic. And here's the completed schedule on the interest coverage ratios. It gives us the ratings and the cost of debt at the different ratios right on up to 90%. Notice a couple things, right? The earnings before interest, taxes, and the amortization is not changing as the debt ratio is going up. And the reason is that the new debt's not used to make the firm larger, right? It's not taking on new projects. It's actually buying back equity. So what's going on is you're isolating the effect of the financing decision on the value of the firm, right? You're not trying to change the size of the firm. And again, you're being, it's a little bit simplistic. I mean, you're assuming that the interest coverage ratio is the basis of the ratings. Okay, that's really not completely true, but it works for our purposes. I mean, you could use another ratio or even several to create sort of a consolidated score. A good example of this is called the Altman Z-score. And then you could make ratings. The effective tax rate also decreases after the 80% debt ratio, right? That's really because you'll have insufficient income to cover the entire interest expense beyond that point. So anytime the earnings before interest and taxes goes below the interest expenses, right, you got to lose a little bit of the tax advantage from the borrowing, all right? Now that brings up this topic, the issue of the statutory versus the effective tax rates. And the general lesson on this slide is it's somewhat conservative, right? The interest that's not being used for tax deductions can actually be carried forward, and you can get some tax benefits in future periods. So remember what you're doing. You're putting into place a permanent change in the capital structure. And what we want to do is just be more conservative than usual so that you look at the interest expenses that do provide you with tax benefits in the current period. Okay, so you got to just watch out for the tax effect a little bit. That's the general lesson on this slide. So Disney's cost of capital situation looks like this. It summarizes the cost of the equity and debt from the prior pages and then puts into place the cost of capital at the different debt ratios. If the objective is to minimize the cost of capital, that occurs, see, at the 30 and 40% levels. So the 40% is shaded. It's not a very dark shade, but if you alter the screen lightness, let me see if I can do mine. There's a little bit of shading on 40% to try to highlight it. I should fix that. I'll do that later. Okay, let's get back bright. So our objective, right, being to minimize cost of capital, we're finding it in that increment between 30 and 40. If you want to be more precise, work in, say, 1% increments between the 30 and the 40, and even maybe go outside that, maybe go 30 to 50%. And as you move in the 1% increments across that, you'll find actually that Disney's cost of capital minimizes to 7.28% when it gets to an optimal of 43% for the debt ratio. And of course, that will maximize the firm's value if the operating cash flow is unaffected by changes in the leverage and the consequent changes in the ratings. The idea being, right, you're assuming no indirect bankruptcy costs. I mean, the optimal amount of debt might be constrained, of course, if you run into the potential for probabilities of engaging in bankruptcy, right? So that's the idea behind it, constraint in terms of how far do you want the rating to drop for a company. And what you see is the cost of capital chart for Disney here. It's minimized at 40%. And then you notice, right, the cost of capital, it doesn't rise very smoothly. There's a little surge in the cost of capital just beyond the 40%. It turns out that's just typical. It represents a tipping point, you could call it. You're going from being comfortable with debt right on up to the sort of the limit case. Right? And you're pushing to that limit. And then, right, your interest ratios are decreasing, and you're pushing up the cost of debt, and you're pushing up interest expenses, pushing down the interest coverage ratios, and that creates a spiraling effect. Now, some people get fixated on assuming that we made debt to have a zero beta, And then, you're computing levered betas. You want to re-estimate optimal by allowing the debt to actually have a beta. And if you back into the beta for debt by taking a default spread at the debt rating, you're going to find some proportion of risk arising from the debt now in our calculations. And right, you're spreading that risk over to the bondholders is sort of the lesson there that might guide a slightly adjusted analysis. Here's Disney in 1997. And you can see there's a little bit of a kink in the cost of capital curve at the 70% level. And that's because costs of debt, right, in calculations can be often discontinuous. And so, right, the cost of debt has a large change, remember, when the rating changes. And so the lesson there is, right, in reality, cost of debt, even inside a particular ratings class, it's going to vary depending upon the firm's position inside a class. I mean, you might have, right, a AA rated firm kind of on the high end or possibly on the low end of the AA rated kind of firm. So, I mean, if you want to, you can make the cost of debt a continuous function of the default risk or of the interest coverage ratios. It's a little clunkier looking kind of a curve here just because of the way we're linked to the ratings classes, which is very common with classification types of data. All right, so now Disney should do something because we've just discovered that we can increase Disney's value by a restructuring. So under the cost of capital approach, we're holding investments constant, and we're just changing the financial mix to see, right, how does this affect the cost of the capital? So the recommendation that flows out of a recapitalization analysis is this: borrow money and buy back stock to increase the debt ratio, or issue stock, right, and repay debt to lower your debt ratio. Those are our options, right, in terms of how you might approach this. And, in this case, Disney has potentially, call it compelling evidence to make a change, right? So why should we do it? Like, look at the full valuation on Disney. Now, step one, right, you're estimating cash flows. Always do that when you're working on valuations. Now, back out the implied growth rate in the current market values of the firm, and then revalue the firm when it has this new cost of capital. Okay, so the change in the value of this firm, look at that, it's running an increase at nearly $40 billion. Now, that assumes a couple things. First, well, the firm is correctly valued right now. So there's no, market-based mistake. So we're valuing this firm, but not really in the belief that there's market efficiency. Remember, we're isolating the effect of just changing the cost of capital. So, put it this way: whatever the market's expectations might be right now, whether they're realistic or unrealistic, those expectations, we say, would stay unchanged as we go from from the old to the new capital structure. So this tends to break down a little bit, of course, when you have a very high growth rate kind of firm, or when you have a firm that's just a money loser, right? The valuation models get far more complicated in those cases, right? So you got to watch out for how appropriate it would be to use this methodology in those situations. Now, the next thing we want to look at is, how one is got to process this value effect in terms of here, as we say, the incremental approach. See, the reduction in the cost of capital is basically annual savings, and the savings are, of course, implicit because they're kind of built into the cost of equity, right? Now, the firm's accounting earnings are not really directly going to reflect this change in the market value of the firm. So you got to change the savings into some kind of present value, you got to discount back that new cost of capital, right? So a good thing to do, of course, is just assume growth in the firm's value. So that's always something that you got to work with. And a simple way to estimate that is with any kind of current growth attributed to the firm by the market. So you estimate the firm's value right now, and you look at the free cash flows to the firm and the current cost of capital. Right, that whole framework then establishes for us a basis for a simple valuation. It actually yields stable growth forever, so you could think of it as sort of an average case. Now, if you have a really high growth firm, the formula yields an implied growth rate that's actually going to be far too high. It might even get really close to the cost of capital. So it's really better to put a cap on a growth rate in such a situation, probably a cap that's based upon the risk-free rate. Okay. In that case, right, maximizing a firm value is going to maximize stock price if, remember, debt is being refinanced at the current market rates, and so you're protecting the bondholders also with good covenants in that situation. And we're thinking, hey, markets are rationally efficient in such a situation. Now, as you read this slide, I just have a very basic comment about this. Right, if the investors are rational, the price on the buyback, it should be such that investors are indifferent between selling back their shares and holding on to them. In this case, it happens at the value of $78.61. Okay, so you're trying to establish the indifference price, we could call it. Now that harkens a little bit back to microeconomics, and it's us being aware of, in a strict sense, the values embedded in prices are accurate values, and the incentive to buy or sell back shares becomes moot, right, at this valuation at 78.61. Now, there's a general solution. Here's the general scenario. And what you do here is you look at the division of the spoils between those who sell their shares, right, and those who decide to stay as stockholders. So that solution continues. You can hold this, maybe pause this slide to review it a little bit, but I'm going to jump forward to 58. So on slide 58, you can start off with a certain price. In this particular scenario, you could call it a best case scenario for those who want to stay on as the stockholders. What happens here, you'll notice, is that the stockholders are going to claim the entire surplus. Remember, what's going on is the firm is adjusting its financing structure, so the value of the firm rises. That's generating a surplus, right? The difference between the final value of the firm and the current value of the firm. And that surplus should be shared, right, across those who sell back their shares and those who hold it. In this particular case, you're offering, the current old price on the shares. So, right, those who sell back are selling back at the market price. They're not enjoying any gain, right, that comes from the restructuring. So that's best case scenario for those who stay as stockholders. If you go back to the rational price, you'll notice a little bit of a proof arises, right? Turns out the proof is based upon the notion that the $78.61 price, it leaves everyone equally well off. You could try a bunch of different prices and look at how the value gets apportioned between groups. And in fact, you could try estimating a buyback price where the entire value goes to those who sell their shares back, right? So that's possible to do. Now, the analysis that is the foregoing is a commonly practiced kind of case. It works in certain situations pretty well. Now, what if something goes wrong? Okay, so the analysis is based upon the firm continuing. First off, I mean, it's a going concern and it's going to have a future life, right? And when you start pouring into the firm, say, more and more and more debt, because we're going to ratchet up debt maybe of ADP or of Disney, okay, it could put the firm's survival at risk in certain cases. So it's really critical to do what we'll call what-if analysis, right? And you put into place here constraints, call them survival constraints. So that's the idea behind this second point. If you look at Disney's operating income history, the percentage changes in operating income are now identified. And so we're being a little more realistic. We're examining, what's happening across time, and is there a point at which Disney would be in graver danger, right, if it's in deeper debt. So this gives us a little historical reference. And what you notice, right, is earnings before income, interest and taxes, right? It's low at some points, high at some points, and varying quite significantly, right, from one year to the next. It looks like the highest rate of change, 49%, that's the 2003 to 4 period, right? And then you have a pretty significant downturn. Not often, right, but significant in that you got percentage changes. Let's see, the most radical downturn looks like was in the year 2000, right, minus 29.47%. And you see how that was following on a sequence of pretty low percentage downturns, right? And so you got that information in place to give us what we'll call these safety constraints or safety buffers. Disney's optimal debt ratio is pretty robust, you'll notice, because it survives right on up to about a 30% drop in the earnings before income, interest and taxes. Look at their worst year in the last 3 decades, and you kind of see this edge case. So what we want to do is put a constraint in place. So the rating constraints are a good way to buffer your analysis against an assumption that the operating income isn't going to change as the leverage changes. So now we're going to allow the operating income constraint to put into place, right? It could be that the operating income may suffer when the ratings fall. So you want to have managers, kind of hand them a lower edge under which they're willing to operate. And a lot of managers like to brag about having high ratings. It just makes sense. So, right, the questions that come up are whether the high rating is really paying off in terms of the higher operating income. If it's not, how much are the stockholders, paying for the manager's bragging rights? That's a good way to put it. Because, hey, we love having a high rating. Hey, you're under leveraged and you're causing the firm value to decline. And that damages the shareholders, and that's irresponsible, right? For Disney, a rating constraint, and this will be our last slide on this lecture, we saw really technically a 43% ratio if you dive into small increments, but let's set it up at an optimal debt of 40%. It's there when Disney gets its rating of A. It could be, of course, that the managers refuse to drop to A. So they say, we must have a AA rating. So then the optimal debt ratio for Disney would be 30%. And now you calculate, right, the cost of the ratings. It's not too bad of a cost. It's running now the difference between the value of the firm at 40% and the value at 30%. So that's only about a $5.7 billion difference. If the managers insist on a AAA rating, the optimal debt, right, drops to 20%. And now the costs of such a rating are getting significant. Right, the highest firm value at 40% of the ratio for debt is at 153-ish billion, and now at 20% the firm is valued at 141 billion. So that's a $12.125 billion difference. Now that could be overstated. We're basing our assumption on this fact, right? The operating income is unaffected by the changes in the ratings. So it's just sort of simplistic in that sense. So there's a degree to which, right, Disney's operating income is going to drop if its rating drops below BBB. We know that's the case. So you're really going to overstate the cost of a constraint potentially. The process can also be modified to have some other constraints in place, right? So sometimes a firm says they don't want their book value debt ratios to rise above, say, industry averages. So they use this as a kind of a pretty easy reference point. There also could be, of course, some existing bond covenants that actually restrict the financial ratio from going beyond a certain specified number. So, of course, now the bondholders are protecting themselves, and that's imposing a welfare hit, right, on the shareholders by potentially decreasing the firm's value. So I'm going to wrap that one up and post it for you guys, and you'll notice because Screencast isn't doing uploads these for some reason, I'll be putting these into YouTube, which should work pretty well. All right, so that's it for now, and keep working hard, guys. You're doing well.